All right, welcome to Talk Tickers. We're diving straight into the signal today, unpacking the first quarter fiscal year 2026 earnings call from Workday.
Yep, this is your quick guide to the numbers, the strategy, and what the top brass CEO, CFO, President of Product and Tech had to say.
All introduced by their VP of Investor Relations, covering Q1 FY26.
And of course, they kicked off with the usual reminders, the forward-looking statements, the non-GAAP measures, standard stuff.
Necessary ground rules. Okay, let's jump into the results then. The snapshot for Q1, how did it look?
Well, management called it a solid start to the year. They seemed genuinely pleased. Subscription revenue hit $2.059 billion.
Okay, and the growth rate on that?
It was 13% year over year, but they did point out if you adjust for the leap day last year, it's actually closer to like 15% growth.
Right, that leap year comparison always throws things off a bit. So good subscription growth. What about profitability? How efficient were they?
Very efficient, actually. The non-GAAP operating margin came in at 30.2%.
Wow, 30.2%. That sounds high.
It was. It beat their own guidance, actually. They said it was down to, keeping a careful eye on headcount while revenue came in a bit stronger.
Okay, that margin number definitely stands out. And the total revenue for the quarter?
Total reported revenue was $2.242 billion. So like I said, $2.059 million from subscriptions, and then the other $181 million from professional services.
Subscriptions really dominate, don't they? Was the growth pretty even geographically?
Interestingly, yes. Both U.S. and international revenue grew at exactly the same rate, 13% year over year for Q1.
Huh, okay.
Yeah, U.S. was $1.68 billion, international $559 million.
And looking ahead, what did the backlog numbers tell us? CRPO.
Right, the 12-month subscription backlog, the CRPO, ended the quarter at $7.63 billion. That's up 15.6%.
15.6%.
Yeah, and they did add a little note. They now include subscription contracts for things like implementation or testing environments, their tenants. That added about half a percentage point to the growth this time.
Okay, good clarification. And the total backlog, further out.
Total subscription revenue backlog reached $24.62 billion. That's growing at 19%.
19%. Solid pipeline. And customer retention. Always critical for subscriptions.
Still very strong. Gross revenue retention held steady at 98%.
98%. That's really sticky.
It absolutely is. Shows the platform has real staying power.
Okay, let's flip to the GAAP side for a second. Sometimes those numbers look different, especially with that restructuring they did. How did GAAP operating income look?
GAAP operating income was $39 million, but you really have to factor in the big hit from that restructuring charge.
How much was that charge?
It was $166 million, directly tied to the restructuring earlier in the fiscal year. So yeah, the non-GAAP number really gives you a sort of cleaner picture of ongoing operations.
Right, makes sense. What about cash generation?
Operating cash flow is pretty robust, $457 million. That's up 23% compared to Q1 last year.
23% growth in operating cash flow. Nice. And returning cash to shareholders. Buybacks.
They were definitely active, bought back $293 million worth of shares in Q1.
Yeah, okay.
They used up most of their old authorization, only $59 million left, but then the board approved a big new one.
How big?
A new $1 billion open-ended share buyback program.
$1 billion. That's a serious commitment. So after all that, what's their cash pile look like?
Ended the quarter with a healthy $8 billion in cash and marketable securities.
Plenty of flexibility there. And the headcount number post-restructuring, where did that land?
Total headcount is now around 19,300. So that reflects the changes they announced earlier. So yeah, putting it all together, you see why they felt it was a solid start. Strong subscription growth, margin beat, good cash flow, a positive picture overall.
Definitely. Okay, let's dig deeper then, beyond just the numbers. What were the strategic themes? Management talked a lot about their value proposition resonating right now. What's the angle there?
Well, the thinking is customers are still dealing with, economic uncertainty. So they need efficiency, they need to be agile, and they want to unlock innovation, especially with AI. And Workday, handling finance and HR on one platform, feels they're perfectly positioned. They can help lower total cost of ownership, enable faster decisions, basically be that core system customers rely on.
And AI is obviously a huge part of that innovation story. What were they emphasizing about their AI strategy? What's their edge?
Their big claim is the data. They kept coming back to it. Over 70 million users under contract, trillions of transactions processed every year.
That's a lot of data.
Exactly. And they argue it's clean, high-quality data about finance and HR. That's the fuel, they say, for building AI that's genuinely different and delivers real, measurable ROI.
So is this AI push translating into actual business yet, or is it still mostly promise?
No, they were clear. It's happened now. They said new ACV annual contract value just from AI products doubled year over year in Q1.
Doubled. Wow.
Yeah. And get this, roughly 25% of their customer expansions in the quarter included buying at least one AI product.
A quarter of expansions including AI already. That's pretty fast adoption.
It really is. Shows it's not just talk.
What specific AI products did they mention are getting traction?
They called out a few. The recruiting agent, talent mobility agent, EverSource, that's their contract management AI, and also Workday Extend Pro.
Extend Pro, right.
Yeah, they highlighted that one as growing really fast. That's the tool that lets customers and partners build their own AI apps right on top of Workday.
Okay, so enabling the ecosystem too, did they give any specific customer examples, like real ROI numbers?
They did. Western Union, using EverSource for contracts, reported processing them 65% faster, and they cut their related outside legal spending by almost 70%.
70% reduction in legal spend, that's concrete.
Pretty clear value, yeah. They also mentioned NetApp using an AI agent on like 90,000 contracts, saving thousands of hours and cutting legal spend too.
Those examples definitely help make the case. Anything new coming down the pike on AI products or people?
Yep, they announced a whole wave of new AI agents planned for release soon, focusing on things like talent potential, cost optimization, better decisions, risk management. And they also brought in a new CTO, Peter Bayless. He's got a strong AI background from Stanford, Google Cloud, specifically hired to lead their AI and machine learning charge.
Interesting. Okay, shifting gears slightly from AI, what about their core financials business? That's been a growth engine.
Still solid growth there, they said, both new customers and expansions. A key stat was that over 30% of their net new customer wins in Q1 were full suite deals.
Meaning HCM and financials together.
Exactly. And in some of their focused industries, like SLE state, local, education, and healthcare, that number was even higher, over 50%.
50% full suite wins in those industries.
Yeah. And they also mentioned successful go-lives for financials at places like BJ's Restaurants and Essentia Health.
You mentioned SLED. They also talked about reaching smaller companies, right? A new initiative.
Right. Workday Go. That officially launched. It's aimed squarely at the emerging and medium enterprise market.
What's the main pitch? Faster deployment.
That's the key. They're aiming for deployment times as fast as 30 to 60 days using pre-configured setups. It relies heavily on partners and has like a fixed price model to make it simple. They said it's already moving the needle in that segment.
Makes sense. How about performance across different industry verticals?
Well, they hit a milestone. They now have 5 industries, each generating over $1 billion in ARR.
$5 billion industries. Which ones were added?
Manufacturing and technology and media just crossed that threshold in Q1. They joined financial services, retail and hospitality, and professional and business services. Shows the breadth, right?
Definitely diversifies the business. What about the federal sector? Any updates there?
Still a focus area. They mentioned positive engagement, building a foundation for, long-term growth. They stressed how much need there is for modernization and efficiency in the U.S. federal government, which is, well, exactly what Workday aims to provide.
And partners seem to be playing a bigger and bigger role.
Oh, absolutely.
Yeah.
They kept bringing up partners. Partners sourced over 20% of the net new ACV pipeline in Q1.
20% sourced by partners.
Yeah. They gave examples like a managed service deal with Mutual Group. And their Global Payroll Connect program now covers 187 countries through 29 partners. You can even manage like 60 global payrolls under a one Workday contract now via their partner Strata. They also mentioned their Built on Workday program is gaining steam. The developer community nearly doubled in a year. 25 new partner apps hit the marketplace just in Q1. That ecosystem's definitely growing.
And globally, outside the U.S.
Solid growth reported across AMIA, that's Europe, Middle East, Africa, Asia, and also Asia Pacific and Japan separately. They gave customer examples from each region.
Any infrastructure moves?
Yeah. They mentioned going live on the AWS UK public cloud and also announced a new AMIA headquarters plan for Dublin. So continued investment internationally.
Okay, that covers a lot on strategy. How are they thinking about using their cash? Capital allocation priorities?
Pretty clear priorities laid out. Number one, invest in organic growth, especially AI and go-to-market. Second, strategic M&A, but they stress the bar is high there. And third, return capital to shareholders through buybacks. Hence that new $1 billion authorization, partly to offset stock compensation dilution.
And the plan for headcount now, after the restructuring, just keep it lean?
The plan is described as thoughtful, measured hiring, focusing just on those key growth areas. So yes, they reduced headcount, but the idea is to carefully build back up over time, staying efficient. The CFO, Carl, basically said, focus on controlling what you can control, deliver innovation, deliver ROI.
Right. Okay, so that leads into the investor context.
Right.
How are they seeing the big picture, the macro environment, and what gives them confidence?
Well, they acknowledge there's still uncertainty out there. They're watching closely, especially in markets like SLED and some international areas. But their official line is that they haven't seen that uncertainty really translate into a meaningful hit on their overall business or growth prospects yet.
Okay. And despite that uncertainty, they stuck with their full year guidance for FY26. What's backing that confidence?
They listed quite a few things. The value proposition, that ROI TCO message really landing, the trend of customers consolidating onto Workday, the AI traction we talked about.
Right.
Also, continued momentum in financials, the growing impact from partners, and their focus on international and federal markets. All those things together give them conviction in the $8.8 billion subscription revenue guide.
Did currency exchange rates factor in at all, FX?
A little bit, yeah. It actually turned slightly positive for them. Last quarter, they expected about a $20 million FX headwind for the year. Now they're seeing roughly a $10 million FX tailwind. Not massive, but helpful.
Okay. They also talked about the pace of subscription revenue growth changing through the year.
Yeah, they expect it to accelerate a bit in the second half, especially in Q4. Part of that is just timing, how revenue gets recognized from bigger deals closed earlier.
Yeah.
They mentioned the big DIA contract as an example where revenue ramps over time.
Got it. There was also a question about billings growth versus CRPO growth. Q1 billings looked a bit lighter, maybe? How did they square that?
They explained billings can bounce around more quarter to quarter. Things like seasonality, when deals close, customer payment terms, even longer deployment times in some growing sectors like education can affect it.
So CRPO is the better metric to watch.
That's what they stressed, yeah. CRPO gives a better view of the underlying backlog and future revenue. They said Q1 billings were actually in line with their internal plans and still support their full-year cash flow guidance.
And on AI monetization, they sound pretty confident it's happening now, not just down the road.
Exactly. They kept saying AI is already moving the needle. Pointing to that doubling of AI ACV, the 25% attach rate on expansions, they expect it to get even stronger when those new agents launch later this year.
Yeah.
The message was clear. AI is contributing today.
What about margins? Q1 was over 30%, which is basically their old FY27 target hit way early. How are they talking about margins for the rest of this year, FY26?
Right. Despite that strong Q1 beat, they actually reiterated the full-year FY26 non-GAAP operating margin guidance at around 28.5%.
So not raising the guide despite the beat.
Not for the full year, no. They said the outlook reflects planned investments throughout the year in AI, go-to-market, etc. So balancing margin expansion with funding growth.
But longer term.
Longer term, they were clear they're still focused on achieving and expanding margins beyond that 30% mark in future years. So they definitely see potential for more leverage down the line.
Did they say if these new AI agents are affecting sales cycles, making them longer or shorter?
Interestingly, they said for selling back into the existing customer base, the AI agents are actually accelerating sales cycles.
Faster deals.
Yeah, because if customers see the value quickly, those AI deals within the base tend to close faster, often within the quarter, like in 90 days.
Okay. So summing up their narrative, it's about clear ROI, being the safe consolidation platform, and having this unique data advantage for AI.
That's pretty much it. Trusted foundation for the core stuff, but also leading edge on practical AI for business.
Okay, let's do our not financial advice segment. Remember, everyone, this is just for illustration. A speculative idea based on the call themes, definitely not a recommendation. So thinking about that AI traction and the margin beat, what's an outrageous but plausible idea?
Right. Purely hypothetical here, not advice. You could look at those AI data points, the ACV doubling, 25% attach rate, new agents coming, and build a speculative case. Maybe a long position arguing the market isn't fully pricing in how quickly AI could ramp up and potentially drive revenue significantly above the current guide.
Okay, so betting on faster than expected AI contribution. And you could maybe layer on the margin angle too.
Exactly. That 30.2% margin in Q1 beating Biden's, maybe that signals better underlying efficiency or cost control than expected. So perhaps the full year margin also beats the 28.5% guide, maybe even hits 30% this year instead of waiting for FY27.
So the speculative trade idea, the outrageous but plausible one, is basically the combination of accelerating AI revenue and sustained margin outperformance drives upside to both the top and bottom lines.
Potentially leading to a re-rating of the stock multiple, yeah. Assuming, of course, the macro picture doesn't fall apart. It's really leaning into those specific positive signals from the call.
Purely speculative, connecting those specific dots. Again, everyone, strictly illustrative, not financial advice.
Absolutely critical reminder.
So, wrapping up our deep dive on Workday's Q1 FY26 call, key takeaways. Definitely a solid financial start to their year. Business looks resilient, diverse.
And importantly, real signs that their big strategic bets, especially on AI, are starting to pay off with tangible results, leveraging that data advantage they keep talking about.
Right. And just remember, everything we discussed reflects management's views at the time. Forward-looking statements are involved, and this chat was purely informational based on the call.
It certainly gives you a very detailed snapshot of their current position and execution.
Definitely something to chew on as you follow the enterprise software landscape.